Welcome, guys and gals, boys and girls, traders and investors. This is Larry Williams. Now, we have not used this particular format yet, so I want to make certain you can hear me. If you can raise your hand, could you raise your hand if you can hear me, that we have audio working here? Oh, good, Vladimir, thank you. And also, if somebody would type in one question. I'm not seeing on my screen where I get questions, so if somebody just asked me what the time of day is or something, and because I know the answer to that question, and we'll figure out how we get questions. So we're looking for a question coming in. We've got sound. Okay, good. Thank you very much. That is up and working. So, wow, it's always such a pleasure and so humbling to see people from all over the world. Some of you are at 2 or 3 in the morning, and some of you we've known for many, many years, a couple of generations in your family. So I'm looking forward to this. So I've got a lot to talk about today. So, hey, let's get to it. Can we really know the future? This is a huge question. Can we really know what's going on? Well, I think anybody can forecast the future. The hard part, though, is to forecast it correctly. And a lot of people claim to do it. I even claim to do it to an extent. But I think the truth of all this is, based on my years of doing this, almost 20 years of doing these forecast reports, that not everyone gets it 100% correct. You cannot expect that. In fact, it's foolish to say the markets are totally predictable. So don't think that I can predict the markets to the nth degree, or anybody else can do it. We can get an idea, and that's going to be really important. I'm going to show you those ideas of what I think will be happening in 2020, and also how we can use this in our trading as well. Of course, if we have questions as we go along, feel free to type in those questions. I'm sorry I didn't mention that. So there's no magical formula that defines the future. I have spent tens of thousands of dollars on other people's courses, going to people. The highlight was trying to find an Indian astrologer in London maybe 50 years ago. Finally finding him and getting there, and I think his children knew more about the markets than he did. So there's no mystical, magical thing to this. It's a lot of hard work. And we can't get an exactness of the future, but we can get a pretty good glimpse of the future. Now, that's really helpful if we can get a glimpse of the future, because if you have an idea of where you're going, north, south, east, or west, that's going to be helpful to you. That any view of the future is better than none. And that's really a very powerful statement when you think about it. If you have some type of a view of the future, where you're going, which way is north, you're ahead of the game. This is what most traders know about 2019. It's a blank page. They really don't have a clue. So what's going to happen, say, in the dollar index in 2019? That's their view of the future. In fact, there is another view of the future. I'd like to share that with you right now. My view of the future, of what I think the dollar index will do in 2020. I'm certain you want to take your screenshots now, get out your cell phones, whatever. Take pictures. This is the first forecast you'll be seeing of what I expect the dollar index to do. It should come down until about the end of January, have a pretty good rally up until about May, and around September 10th, a pretty good buy with a rally into the end of the year. So that's an overall view of the dollar index. And suddenly, what a difference we have between what most traders are thinking about will happen in the dollar index this coming year. They kind of really have nothing but that, a blank screen, versus what suddenly we can see, a perspective. Will the market follow this exactly? No, of course not. But as we get into January 23rd, we get around the 1st of May, then we can be looking to take signals and seeing how close prices following the forecast. So we see if we're on this roadmap. That way we can really trade using these forecasts and views of the future. Now, it can't be done exactly in the future, but we can get a pretty good glimpse. As I mentioned, we're going to be looking at a forecast here of the gold market. This was from our forecast update of 2019. We do a free report at the middle of the year of our forecast report, and you can see at this particular time it looked to us like gold should have a nice up move and then rally towards the end of the year. That was the forecast. And the interesting thing about forecasts is you got to hold your feet to the fire. We can tell how they actually came out, and this is how it actually came out. That low that you saw in the first chart was right here, and we did get the rally, and we got the pullback that we were looking for. So generally speaking, yes, we can get a pretty good sense of when these markets should top and bottom. Forecast we did for crude oil in the mid-year update, you can see the forecast report. We were looking for a rally to start about the middle of the year in crude oil and have a rally up and then a bit of a pullback. And the nice thing about that, again, is we can go look and see, well, how did this come out? Did it come out well? Was it helpful or not? And it came out pretty good. The blue line represents right when we thought the market would rally. It has, not as spectacularly as the cycles thought it would happen, and that's a really understanding cycles. A little bit later in the presentation, I'm going to show the real secret of cycles and how to take advantage of that and how to use that. We also did a bond forecast for 2019, and you can see that coming on your screen in a moment. The red line at the middle of June, we were looking for the market to come down, set up a nice buy point in July, and then a sell-off. So with that general idea in mind, then, here's what actually happened in the marketplace. We were looking for a sell-off to take place about here, and a buy signal about here, a sell-off here, a buy here, and a sell here. All these points were known 6-7 months in advance. Again, it's not going to tell us right to the day. If that's what you're looking for, I'm not your guy. Good luck to you. But again, if we can get some view of the future, it's better than no view of the future. And here's why it really matters. I'm in a silver trade right now. You can see the chart right here. I'm long 20 silver. And you can even see where I bought it. Not very good. I bought it here and I bought it here. I thought we had bottom. We ran up and we came right back down here. And I would say with a pretty good loss. But I was worried, but I had a vision of the future. That's the red line, the forecast technique. So I had a vision of the future. Said, hey, Larry, you know what? You're going to give this a little bit more breathing space because this is what should be taking place here. The cycles were bullish, the intermarket relationships were bullish, so I held on. Now I'm sitting with the $37,000 profit on the trade. You can see where my targets are up here. If it gets to my target, it's a $122,000 trade. This is real time, real trade, real stuff, right? So you can see how I can use it to help you understand when you get particularly concerned about a trade as well as getting in. I had a similar position in gold, and here is the gold forecast. I started buying gold here. Now my entries were much better. I bought it here and here. Much better entries. I'm long now. We've got, about a $56,000 profit in the trade. Why did I get long here? Well, a couple reasons. My percent R was in the buy zone. The forecast said to the upside. Cycle said to the upside. Seasonal said to the upside. So a lot of stuff going on that we knew in advance about these things taking place that helped set up the trade. And then, when the market started to pull back here a couple of days, I was really hurting in silver. It wasn't quite as much in gold, but I didn't have to be worried about it. I could live a little better and trade a little better with that view of the future. Again, it's a glimpse of the future. It's certainly not a perfect view of the future, but hopefully you see how this can be used. So let's talk a little bit about the stock market now, and I will have a gold forecast for you right at the end of this report, what I think is going to be continuing happening in gold and gold in the first part of the year. That will be our last forecast report that we'll make. So this was an update we did on the forecast of the stock market. Notice that we thought the market would start to bottom about September of this year and have a nice run up until the end of the year. This was all that we known right back here. The red line and the blank space was unknown. We had no idea that was a forecast. So then we want to see, well, what actually happened. And to make these forecasts, I found it's better to use a combination of things. I like to use the advanced decline line. You're seeing that on your screen right now. It's kind of the internal strength of the marketplace. And it was saying that we should start to rally in June, and again about August, September, start to rally and have a nice up move in the marketplace. So that's a view, if you will, or a glimpse of the future that we can get. Of course, always have to put our feet to the fire. Does this stuff really work? That's really important because if it doesn't work, we shouldn't be using it. This is how it came out. This was the peak we were looking for. There was one low, another peak, another low about the same time mixed, and another strong peak where everything should rally, and that's exactly a great buy point. So again, the problem with cycles is you get these points along the way. The magnitude and the exact meaning of it, we really don't know. It's a stretch, I think, to say that we do, unless we can confirm that and back that up with some other technical tools. Then we can make a lot more sense of all this. Well, here's a lesson from my 2017 forecast. The market you see here was 2017, and the red line is a forecast that we made in our chart number 8 in our 2016 forecast report. We thought the market would run up, dip, run up, dip, run up. Did all that perfectly until, we thought it would dip and then run up. Well, it didn't dip. It went sideways and ran up. This is the problem with this stuff. It doesn't tell us necessarily the magnitude of it. So we're looking for a decline. We got that one. We got this one. But again, that's the art of trading. We have to learn to play this stuff and to play this stuff correctly. Let me see. There are some questions coming in. The recording this is being recorded. You will get a link to it as well. So if that's a problem, it'll be about an hour. Yeah, I don't think we may not even stretch it to an hour unless there's a lot of questions, or I can really ad-lib a lot here. Okay, let me get to our next chart. In the 2018 report for 2019, we also did some forecasts. We showed the 65-week cycle, which had been pretty strong, set a low about June 30th, 2019, and October 9th. Well, October 9th this year was a really good buy point in the marketplace. 630 wasn't that good, but it does give us a roadmap and an idea in the future of where to go. Now, I see a question has come in here. You can still hear me. If you can't hear, by the way, if you're cutting in and out, log out and come back in. The forecast works on the NASDAQ stuff. Abdi, yeah, I think, again, we can forecast all this, but how correctly we can forecast it. My experience is the stock market is the easiest to forecast. Why? We have a lot more data. The cycles are more managed, if you will. They're not as erratic. The news isn't as erratic as, say, in cocoa or coffee. So I think those are the markets that are the most forecastable for us when it comes to being able to make forecasts. Here was our forecast for 2019. You can see a blue line coming in the next chart we're going to show here. And that should be on your screen about, there it is, a red line, I'm sorry. That was based on a model that we had, and this was out of sample. This was something we showed a year ago. Of course, the big thing is, well, what happened? And you probably know what happened in 2019. Pretty much an up year all year long. And if we look at the forecast, which you saw, and now here's what happened, pretty much what happened. The dips that we saw in the forecast in here came out correctly. So using that model, I can get a pretty good idea of what I think is going to happen in 2020. And that will be, of course, in our 2020 forecast report that we'll be releasing before much longer. Go to my next slide here. These slides are running a little. Okay, so this is a bit like peeking at your cards is the way I like to think of this. We have an idea. If you can cheat and you got maybe 5 cards and you look at 2 of them, you see you have a 7 and an ace. You don't know the rest of the cards in the deck. That's really what forecasting is. Hopefully with forecasting we can get a look at 3 of the cards, maybe 4 of them. We still don't know what the kicker card is or the last card is, but we get a pretty good idea of how we should play this hand. That's where forecasts are really important. The thing to me is how to use a forecast to make money. As you've seen in my trading, I use it in my trading. And so how do you use this stuff? I think that's really important. And how do we know the future? Well, there are some ways we can know the future. I'd like to share those with you. The things that I think give us an insight into the future are fundamentals. I'm going to be showing you some of my fundamental indicators in a moment. Seasonals, I do think the markets do have seasonal influences. Cycles, we've talked about those short, very short ones and long-term ones. Intermarket relationships, you saw some of those as you follow Larry TV. We've used those there, and I'm using it in my trading. And big question mark, astrology, the arcane, does that stuff work? I really don't know, frankly, and it's something I've never really tried to learn for a couple of reasons. It's a lot of detail. It's a bit over my head, and I'm really comfortable with the indicators I have, particularly the fundamental indicators. The one I'd like a lot, and I've shared this with you, is the yield curve. You can see the yield curve. Notice how the yield curve is flat in here back in 2007 and the bear market began. Well, people this year were going crazy about the yield curve. Well, it's the direction of the curve, not necessarily if it's positive or negative, but the direction. When the direction is flat like this or down like this, stocks experience problems. Now, that's a fundamental consideration. It has nothing to do with cycles or time or any of that. This is the reality of the marketplace. So you're probably wondering, well, where are we right here, right now? Well, this is where we are, right here, right now. The yield curve, as I'm talking today, has a bullish slope to it. You can see that bullish slope. I've done it in the yellow line over here. That's positive. In fact, there's been a bullish slope this entire time period. So while the Cassandras were prophesying another depression because of the yield curve, we never took that view here. It's simply because of the shape of the curve. It's still bullish. That's positive, which suggests to me if we're going to have a recession in 2020 or a bear market, not yet. Another indicator I like to look at is inflation. If inflation gets really high, we're going to have real high interest rates. That's bad for stock market. Well, the Federal Reserve does a really good forecast of inflation. You can get that from the Federal Reserve Bank of Philadelphia, and this is pulled just right off their charts. And what they're projecting is inflation about 2.2. So we don't see inflation rates going high for this coming year. We see them just about where they've been predicting 2.1, 2.2, and we're going now into months ahead. So this is predicting, 84 months ahead into the future based on December data. They don't see a whole lot of inflation coming into the economy. That's positive because low inflation means no high interest rates. High interest rates mean low stock prices. So keep that in mind as a precursor of 2020. But how about business conditions? If you read much in the market headlines right now, it looks like GDP may be coming down. Some people are forecasting bad years in terms of business, but the Philadelphia Reserve Fed also does an index called the Aruba-Diebold Scotty Business Conditions Index. Now, this is a great index to help us in the market. Going back to 2001, notice when it gets about -1, recession start. 2008, -1, recession start. Well, we haven't been there. So the business conditions, as prophesied by the Aruba-Diebold report, which is a great report, and you'll get a link to that in our 2020 report, says business conditions really aren't that bad. If they start to get down here, yeah, we better be worried about a bear market. But right here, right now, we're not there. So that's really good news for us in terms of a larger view of the market. So business conditions right now are not that bad. So what it all adds up to is a potential bear market. If you look at fundamentals, my fear has always been a bear market since I started trading in 1962 because I got walloped. I watched a bear market. I didn't have position in 1962. I did in 66 and 70 and all those others. And as you know, those of you who have known me for many years, I do a lot of research on the markets. It probably isn't a book I haven't read, a course I haven't taken. I have yet to find any technical index that successfully calls bear markets year after year. I have only found that fundamentals call bear markets, and that's why I emphasize the fundamental stuff. It's so important that we understand fundamentals to protect us from the bear markets. And these are things you need to learn about. In our forecast report, I teach them to our readers. I'm going to explain what the massive federal debt means to investors. We have a lot of debt. Donald Trump has increased debt. What does that mean? And how can we use that information to our advantage? And the yield curve we've just talked about. I'll also be showing my 5 best bear market indicators. They're really important because when you see these start to click into place with or without me, you better start to head for the X's and protect yourself because a bear market is coming. I've combined all these tools into an indicator to give us bear market sell signals. And here's the dates if you want to know when the last one occurred, was December 2007, long time ago. So you would think we're going to be having a bear market before much longer. I mean, these things don't last forever. So sure, we're going to have a bear market coming. The question is timing it, projecting when it will happen. The Cassandras have been predicting every year since 2007 have been wrong. So there's only one time for this bear market to begin. It's interesting, I got a lot of emails from people, especially that have read my report, and they're usually like this: Larry, your model must have turned bearish. The market went down. I didn't get a copy of it. Well, I get this, December 23, 2018. Remember, we had a big sell-off in the market. We didn't have any bear market signal. The markets went back to new highs. May of this year, August of this year, I get the same things. It must be a bear market. Just because the market goes down, it's usually a healthy correction. I think we're going to be seeing a healthy correction in the first part of 2020, not the start of a bear market. It will be an optimal buy point. Then, of course, the timing of it will be really critical because then we should have another massive up move in stock prices. If you want to know when the bear will begin, we do, for our forecast readers, give a special insurance policy, if you will, with a free alert service. If we get an indicator sell signal, we notify all of our subscribers that we have a bear market signal. One may be coming in 2020. It looks like now, if this stuff clicks together, it will come late in the year, maybe August of the year, something like that. And I'm not saying it will, because of the 5 indicators I look at, one is starting to drift to the sell side. The others haven't yet. So, I have a little bear kind of halfway out of my desk, but it's not all the way in my desk because it may be happening, but not yet. So what this all adds up to is we also need to have bull market signals as well. These are the bull market signals that we've issued. 2001 to 2008 was a little early, October 10th. 2011, 2 bull market signals right back to back, and a lot of you got our bull market buy signal 12/21 2018 right at the lows. So I try to do long-term market timing in the forecast report. Those are real examples what really happened. The big question about all this forecasting stuff, does this stuff really hold up? Can you really make money doing this? In 2017, we gave forecast readers a specific S&P trading strategy. It made $10,000 that year. Didn't do as well in 2018, a little over $5,000. This year it's made $7,500. The problem with it, it only has maybe 15 signals a year, maybe not even that many. So people wanted more trades. So in this year's report, we're going to have 31 trades to take every year. They support about a 90% accuracy. And the 31 trades have made about $17,000 per year. These are hand-selected trades based on a couple things, based on some seasonality and a couple other things we'll report about in the 2020 report. I know a lot of you want to know how to forecast, so I go into that in the 2020 forecast report year. We're going to give you the GAN's pressure index formula so you can make your own forecasts and you'll be able to see how those forecasts have held up. And probably the most important thing is URLs or links so you can look at these models in the Federal Reserve System, the data I look at, so you can follow this stuff yourself. And keep in mind, 2020 is an election year. These are huge, important years because a lot of things happen in the election year, so we'll be doing a free mid-year report update as well. Now, as you look at those election years, you have to be really careful. I see a lot of people now are making forecasts based on the seasonality of election years, but there's a problem with them. 2008 was an election year, and it was such a big down year, it totally changes the data. So what I do when I look at the data from these prior election years, I throw out the extreme years, like I would throw out 2008. If I was studying a pattern that had 1987 in it, I would throw that out. I might have another 15 years in there, but 1 year can so bias the data. So when I look at this, I want to throw out the outliers, the really bullish years, the really bearish years, to see on average what has happened. That's the way I think we get a presidential good pattern. These politicians are all the same. It doesn't matter if it's Donald Trump or Obama. They all want one thing in common. Their parties all want one thing in common in an election year. It doesn't matter who the dirty dog is. They all want to be re-elected. And the ones who aren't in office, they want a good economy too, or the minority, because they want to get elected and maybe overthrow. So election years tend to be pretty bullish. They have some really strong seasonality patterns. Some I wrote way back in 1973. So this year we're going to have an election year trade in the forecast report. It's happened 22 times in the last 22 years. So it's a high frequency. It's made about $11,000, a little over $500 a trade. It was a very small drawdown. The average drawdown was $350. Right at election time, in that early November time period, the markets get very erratic, very choppy, and they set up some really good short-term buy and short-term sell entries in the marketplace. Here's the bond seasonal pattern. You can see what bonds should be doing. Let that pop up on the screen for you there. The blue line is a seasonal pattern. And bonds typically have a bit of a rally in here, and then they come right back down. And that's about what bonds have been doing. So we can use these seasonal patterns as well to help us identify times. The ideal combination, think about this, if you can combine a cyclical low with a seasonal low with some other ingredient in terms of timing, then you're going to be way ahead of the game. Your view of the future will be much better. Here's the seasonal pattern for gold. Same thing. Well, you saw I'm long, 40 gold. Why am I long so much gold? In part because of the cycle forecast, in part because of the seasonal pattern, in part because of accumulation, etc., etc. Those of you who know me know I really like a combination of ingredients to get bullish or bearish, not just any one thing. Here's the seasonality for the stock market. This presents us a very interesting picture. I've marked off, you'll see that in just a second here, the seasonal highs in the marketplace in the seasonal index, and some have marked good sell points and some have not marked good sell points. Which gets to my position that we can't use just seasonality alone. We have to combine this with something else. And here's the seasonal lows for stocks. And this also makes an interesting point. I really want to stress this, so pay some attention to this. Seasonal low, great. Nice point to be a buyer. Well, not a bad point. Seasonal low, pretty good point to be a buyer. Here's a seasonal low. The market had not been going down. Its stocks went right up. Here's what most people, a trap they fall into. They think because the market should be coming down and stocks aren't, they won't be a buyer here. They should be, because all this is telling us that we should see a rally at this time of the year. Whether we're in an uptrend or a downtrend shouldn't matter. We should see some type of rally. Here again, we saw the same thing this year. The seasonal low is in here. The market had not been going down, so people, well, I can't be a buyer here. Yeah, you can. It's actually even stronger. So here's the message of cycles I'd like to show to you. The black line are cycles. As cycles are made mathematically, the amount of time from this point to this point is the same from this point to this point. And the height from here to here is the same as the low from here to here. So while we can look at a cycle and predict these things out, it's totally different when we get to markets. This is a pure cycle. Peak to peak to peak, equal distance. Low to low to low, equal distance. Highs to lows, equal distance. Unfortunately, that's not the reality of the marketplace. Let me show you. The yellow area here is out of sample. This cycle was done in 2018, and this said we should rally up, come down, rally up, come down. Whoa, like a big decline. Well, we had a decline, but it wasn't a massive one, was it? Again, my point is cycles are about time, not magnitude. It looks like we should have a nasty decline, but you can't count on that. So don't read into these cycle forecasts magnitude. Say, oh, I should be looking for buys in here and buys in here, but don't think it's going to give you the answer to the size of the move. That's going to come from fundamental stuff. Okay, this is what you've been waiting for, the mother of all cycles. Gertrude Shirk, who wrote for the Foundation for the Study of Cycles way back in the 1950s, wrote that the 40.68 month cycle was the strongest of the thousands of possible cycles the foundation for the study had found. This was the big one. And she said it certainly is common sense to attach a high degree of significance to the cycle, which continues to follow the extension. Now, this was done in 1951. Ready for that? 1951. We're out of sample 70 years. And it's changed a little bit, or it did in the 60s, to about a 48-month cycle. And there's a forecast high and low, high and low, high and low, high and low, calling the 1980 low, the 1977 low, the 1970 low. Pretty good, a general ballpark for a long-term view of the future. We can bring that up to see where we are now using that 49-month cycle. And again, this is going to be out of sample. The next big low point in the cycle, notice these low points have been pretty good time to be a buyer right back here for that last upthrust in the bull market ending in 2008. It looks like 2021, late 2021. I'll give a closer forecast in a moment. But again, this is all out of sample data. So it's held up pretty well to give us an idea. If we go back to the 48th month cycle, it looks like about January 1st, 2021, we have our next major buy point. It does not mean we're going to have a bear market. See, we didn't have a bear market here. Remember, that's the formation of cycles. They go from peak to trough, peak to trough. Here we did have a bear market. Yeah, we went into recession. We had fundamental negative stuff. But we can say, oh, the good buy points were here and here and here, and here's one that's coming up. So I'm going to refine this a little bit more for you to give you a more clear picture. This is now using the 42-week cycle with a little bit of my own optimization in it to forecast from 1995 forward. A buy point, yeah, great one. Another buy point, another buy point, another buy point in 2005. Keep that in mind as we look at our next chart. We have another buy point. There's the 2005 buy point. You see that on your screen about now. That's the 2005 buy point here, the 2009 buy point, another buy point in 2012. Again, just because it goes down doesn't mean we're going to have a bear market. Again, don't read that into this, right? It says, oh, great buying opportunity. So when's the next one? Here it is. And the general long-term pattern, if we are to have a bear market, it's going to look like about the middle of 2021 and the next really great buy point towards the end of 2022. And again, we don't read into this a bear market. It may or may not happen, but you can see the next major mortgage the house, get a second mortgage, get a third mortgage, and buy stocks. Not here. We're going to have a good up market, trading range market, but the next really time to massively step in on the alongside of stocks look like it's coming up for us in the future. We can get a little closer view, though, of 2020 by using the 48-week cycle. This is generally what the cycles looks like. We're going to have kind of a trading range market the first of the year, a rally up into July, and then we could start to see the market drift back a little bit. Real-time forecast. This was a real-time forecast out of our forecast report from 2019. Suggested a low in early 2019 and a rally all of 2019, which is exactly what happened, and a peak early 2020. Again, this was done like a year in advance using that 39 to 42 month cycle. Really powerhouse cycle. That is the master long-term cycle. For your long-term traders and investors, this is one you really want to follow. So a question came in, what's in the 2020 forecast? Well, you get charts of all the major markets, all the major stock indexes, US, Japan, China, Germany, Australia, Russia, UK, and individual charts for gold and pork belly, not pork bellies, we don't trade that, more gold and silver and wheat and corn and copper, and all the major markets are in there, so you get that glimpse of the future in the report. And this year we'll be doing Bitcoin too. So you're going to really have all the bases covered. We have readers in 67 countries. This has been a really popular report. It's widely followed. Okay, we talked about gold, a cycle forecast for gold. So here's gold. Gold has a really strong 5.2-year cycle active in it. You can see a pretty good idea of how that cycle's been. Again, these are general by, we should expect a bull market, expect a bear market, expect a bear market, expect a big up move. So that's what the past has looked like. But as traders, we're interested in the future. So here's a future forecast over 2020 based on just the 5.2-year cycle. Now, I wouldn't trade off just this because I want to use the more intermediate and closer term cycles, which of course are in the forecast report. But you get a pretty good idea of the 5.2-year cycle. Late this coming year, we should see a really nice buy point in it. Pretty good rally at the first of the year, then choppy into the downside. So it's nice to have a view today. So I have that roadmap. I get in a trade. I'm a little worried about it. If you don't know where a market's going to go, you really don't know how to trade it. You get a buy signal. What does it mean? But to have that view of the future, we should have a cyclical wave or a seasonal wave or a fundamental wave to the upside here. That's what makes you a better trader, a view of the future. As gold begins now, this is right from the 2020 forecast report. This is what we're forecasting, that we move higher right into the first part of February. Then we're going to have our first dip in the marketplace. The red line is a forecast, so you got a pretty good sense here. We wanted to make this like hors d'oeuvres for you. Really want you to buy the 2020 forecast report. But this isn't just a sales pitch. I want to really teach you and show you how the markets operate. And that's what we do in the forecast report as well. It's a really educational experience. Plus, we have the forecast for you. You could probably do these forecasts yourself if you spent a couple of hours a year at it. That's the time we put on it, a lot of time. And I keep learning. My forecasts, I hope, are getting better because every year you learn a little bit more about seeing the future. One thing I started doing a few years ago is to use intermarket relationships. And this is an intermarket relationship of the dollar index versus the S&Ps. Been a pretty good precursor of what should happen in the future, which suggests shortly we should start to move to the downside. We can look at the intermarket relationship between E-minis and gold. That's going to be the next chart because there has been a strong relationship between those two markets. I see a question has come in. Will Larry TV continues? John, we'll continue Larry TV for a while. We don't know exactly what's going on, but we're going to continue it for a bit. Why a Bitcoin forecast? Well, I think Bitcoin is probably over toast, but a lot of people don't. So we'll still have a Bitcoin forecast. Besides, if the Bitcoin market is the bloom is off the blush, you probably would want to take sell signals at cyclical highs in the market, right? Canadian dollar, Ron, I don't have a position in the Canadian dollar, but we have a forecast for it in our report. So you can see how gold has led what happens to stocks pretty well. It also suggests the first year we start to come down. So here's real-time trading with this idea. This is another current trade I have on right now. This is the Australian dollar. I'm long 40 Australian dollar. I'm long 40 Australian dollar. Why did I get long here? Well, a couple of reasons. Percent R was in the buy area. Market's in an uptrend, but look at the intermarket forecast report. It's forecasting higher here. So I felt a little more comfortable to get long, bought a couple days ago, and sitting at a pretty good profit, about $20,000 in the trade. So that's how we can use this stuff to get into our positions, maybe have a little larger commitment to the market, feel more comfortable in the trade. But if you get some view of the future, really, really helpful to you. That's what we're trying to provide. Here is the stock market versus the bond market. This has probably been the best leading indicator of stock prices. There's the red line coming on your screen now. I'll let you make your own judgment call on that or what that suggests in the future. But bonds have been a pretty good leading indicator for the stock market. Again, you see we have a view going out 3 months in advance based on these relationships. Astrology, I mentioned that. Well, the only thing I found that I can understand is something called the Bradley dates. A guy named Don Bradley did something way back, maybe in the early 1950s, and these are the dates that he thought we would have turns last year. That should be a turn, wasn't really. That should be a turn, was very good. This one was very good. That wasn't, who knows, it was supposed to turn up or down. But the Bradley dates we also follow in our forecast report. They do have a large following. Some people aren't aware of them. So That's but again, I don't know anything about astrology. Why do we do this? Why do we forecast? You know why? Here's why we forecast. Because in the land of the blind, the one-eyed man is king. And most traders don't have any view of the future at all, as I showed earlier. So if we have a glimpse of the future, we're kings. We're way ahead of the average person trading the marketplace. Our 2020 forecast report will be released December 29th. So get ready for that. We'll send you an email on that. You can get it here at ireallytrade.com forecast 2020. And keep in mind that 2020 is the year of the rat. So you got to watch out for rats in the marketplaces. This is the year of the rat as Chinese see it. Interesting point here, talking about China. China market is very forecastable. Before Donald Trump took office, China was going to eat our economic lunch. They were going to become the superpower of the world. Now, I guess because of Donald Trump's reaction and his actions with China, their market's hasn't quite fallen apart, but it certainly has been one of the weakest markets in the world. If there's been any major accomplishment of the Trump administration, I'd say that's it. America's back as number one economic power or superpower in the world. So it'll be interesting to see what happens in China. Of course, we will forecast that market as well. So in the year of rat, 2020, we hope to read our forecast report. And our thanks for being here today and for supporting my work, so many of you for so many years. I hope you learned a little bit today. I hope you got a little bit of a view of the future for gold, the dollar index, the stock market. What else will we talk about? Oh gosh, the Australian dollar, silver. So hopefully this helps and contributes to your education and understanding of the markets. Until next time, this is Larry Williams wishing you good luck and good trading.